Many people think digital money is a new idea. They think about cryptocurrencies like Bitcoin. They wonder if these new inventions will replace cash. But most of our money is already digital. When you use a credit card, you are using digital money. When you get paid through a bank transfer, that is also digital money. These are just numbers moving between bank computers. The real change is not about making money digital. The real change is about who creates and controls this digital money. This is where a big new idea comes in. A central bank digital currency, or CBDC. A CBDC is official money for a country, created by its central bank but in a digital form. Think of it as a digital version of the cash in your wallet. It is not a private currency like Bitcoin. It is not money held in a commercial bank account. It is a direct claim on the central bank, just like paper money is. This makes it the safest form of digital money a person can hold. The journey towards CBDCs did not begin overnight. For many years, central banks watched the rise of digital payments from a distance. They saw how technology was making it easier to pay for things without cash, but they were not in a hurry to create their own digital money. The existing system seemed to be working well enough. It was a combination of private innovation from banks, payment companies, all overseen by the central bank. Early academic papers and small-scale projects in the mid-2010s were mostly theoretical. Then, things started to change quickly. One major reason was the rise of private digital currencies. In 2019, Facebook announced its plan to create a global currency called Libra, later renamed Diem. This was a wake-up call for central banks. A private company with billions of users could potentially create a new form of money, operating outside any single central bank. It threatened a core state function, issuing and managing the national currency. Another driver was China. The People's Bank of China began research in 2014. By the late 2010s, the ECNY moved into real-world pilots. 2014, China DCEP, Charter 2016, Project Jasper, Charter 2019, Libra announcement, Charter 2020, COVID-19. This put pressure on other countries. If China had a fully functional CBDC, it could gain an advantage in international trade and finance. This created a sense of competition. Other major economies like the United States, the European Union, accelerated their own research to avoid falling behind. The COVID-19 pandemic added another layer of urgency. As the world went into lockdown, two things became clear. First, people became more hesitant to use physical cash. This sped up the move toward contactless payments, digital payments. Second, governments needed to send financial aid to millions quickly and efficiently. Sending checks and relying on bank transfers was slow and left out people without bank accounts. A CBDC offered a potential solution. Money sent directly and instantly to every citizen's digital wallet, a powerful new public policy tool. This simple idea has started a global race among nations to explore what the future of money will look like. The conversation about money is changing very fast. When central banks talk about creating a CBDC, they are usually thinking about one of two different types. These two types are designed for very different users and goals. The first type is called a wholesale CBDC. This is not a currency for the general public. You would not use it to buy coffee or groceries. Instead, it's designed exclusively for financial institutions, commercial banks, and other large payment companies. Its main purpose is to make the plumbing of the financial system work better, settling large payments more quickly and safely. Think of it as a special reserve currency only banks can hold and use. A wholesale CBDC could make today's central bank systems more efficient, especially using distributed ledgers. Several countries have experimented. Project Jasper in Canada, Project Ubin in Singapore. They tested improvements for domestic and cross-border payments, cutting times from days to minutes. The second, more revolutionary type is a retail CBDC. This is what most people think of. A wallet on your phone or a special card, usable for daily transactions by individuals, households, and businesses. China is testing this with the digital yuan, ECNY, used for public transport and online shopping. For many developing nations, retail CBDCs can drive inclusion, governments reaching the unbanked via mobile. Central banks are exploring digital currencies because they see many potential benefits for the economy and society. Here are the most important benefits, simply explained. Financial inclusion. Billions still lack basic accounts, hard to save, borrow, or receive payments. A CBDC could change this. Designed to work on simple phones without a traditional bank. Faster government aid during crises. Cheaper and faster domestic payments. Lower fees for merchants. Improving cross-border payments. Today, slow, expensive, complex. CBDCs could streamline the process end-to-end. Central banks could build exchange networks for instant, low-cost swaps, boosting trade and remittances. Traceability to fight crime. Protect everyday privacy while enabling targeted enforcement against illicit flows. New policy tools, real-time views of payments, even applying interest to digital balances in certain designs. Financial stability. A CBDC is a direct central bank liability, the safest digital money, potentially reducing bank-run risk and strengthening resilience. These benefits drive the global race. Each country weighs them differently. While the potential benefits of a CBDC are exciting, the risks and challenges are equally significant. Central banks are moving cautiously. Mistakes could have serious consequences. The most prominent risk is the loss of privacy. Cash offers anonymity. A CBDC records transactions. Who gets to see this data? A government could potentially monitor every payment, raising fears of surveillance and social control. Cybersecurity, a prime target for hackers, hostile nations, and terrorists. A breach could halt payments and erode trust. Bank disintermediation. If people move funds into risk-free central bank wallets, banks may have fewer deposits to lend, shrinking credit. Massive legal, regulatory, and infrastructure work, plus digital inclusion for the elderly and rural communities. So, why might a country decide to build one? It depends on its problems and goals. Developing nations may prioritize inclusion. Advanced economies may safeguard monetary sovereignty amid private digital money. Ultimately, success hinges on design, security, efficiency, and the balance between privacy and enforcement.